Welcome to my channel. This is the second video in our series designed to help you understand the essential concept for building a system trading setup. In our previous video, we measured the current volatility of stocks based on the ATR value, discussed setting stop loss, take profit level, and position sizing. In this video, we'll explore how these concepts apply to entry and exit strategies. We will illustrate these strategies with an example in the long direction. System trading involves a 6-step process. But at its core, trading is a repetitive cycle of entry and exit. Let's start by looking at the entry process. In system trading, entry is straightforward. It simply involves following the rules of our established strategy. Upon entry, two essential actions must be performed: setting a stop loss and determining position sizing. To make this process easier to understand, let's create a scenario. Imagine the current price of Bitcoin is 20,000 USDT. The ATR value is 2,500, and we have a capital of 5,000 USDT. First, let's talk about setting a stop loss. We'll review this content from our last video and explain it using the following chart example. Suppose our strategy sends a long signal at the candle's close. The price minus 1 ATR, 2 ATR, and 3 ATR would be as follows. Setting the multiplier can be adjusted based on the market, trading strategies, and individual investment environment. Using a bigger multiplier gives us more room before hitting the stop loss. This can help us avoid leaving a trade too early because of sudden price changes. But this method might also mean we earn less, as it lets the price move more before the stop loss takes effect. However, using a very small multiplier might lead to exiting a trade too soon. If the price briefly hits the stop loss and then increases, this could result in missing out on profitable opportunities. By default, our channel uses a 2 ATR multiplier for the stop loss, which will set immediately upon entry. If the price hits the level, the position will automatically close. Unless stated otherwise, strategy discussed on our channel will involve setting a stop loss at entry. Next is position sizing. When we calculate the difference between our set stop loss and the current price as a percentage, it comes out to 25%. If the price hits the stop loss after we've invested all our capital, we would incur a 25% loss on our capital, which is a significant investment risk. To reduce this risk, one method is to only invest a portion of the total capital. One such method is the fixed volatility risk approach, which caps the total capital loss in any scenario. For instance, if we set a fixed entry risk of 2%, we'd only enter with 400 USDT instead of the full 5,000 USDT. This way, even if this entry hits the stop loss, the maximum loss would be 100 USDT, which is only 2% of the total capital. Our upcoming trading indicators will automatically calculate these steps for you. So far, we have covered the two crucial procedures at entry. Next, let's discuss exit strategies. In super trading by Van K. Tharp, exit strategies are considered more important than entry strategies, a viewpoint I strongly agree with. The same strategy can yield vastly different outcomes depending on the exit strategy employed. The way they decide to exit their trade can lead to significantly different financial outcomes. Once we have entered the trade, here's what happens next. If the price hits our preset stop loss, the position will automatically close. But if the price rises without hitting a stop loss, we are in a profitable position. How do we realize this profit and exit position? There are several exit strategies, but today we'll introduce 3. First is the entry-exit rule-based strategy. We exit a trade based on a predefined rule just as we enter. For example, if the entry rule is to buy when the 5-day moving average crosses over the 20-day moving averages, the exit rule could be to sell when the 5-day moving average crosses under the 20-day moving averages. Let's watch a replay to illustrate this. Second is the risk-reward ratio method. These popular exit strategies involves setting a target price at entry and exiting the position once the price hits this target. For instance, if you are aiming for 2-to-1 reward-to-risk ratio and are willing to risk 2 ATR, you would place a stop market order to exit the position once it reaches 4 ATR above the entry price. We'll watch a replay for this method. Third is the trailing stop exit rule. This strategy involves a dynamic stop line that moves with the price, adjusting as new highs are reached. This method limits losses while protecting profits. Let's watch a replay to better understand how this works. Take a look at these 3 examples side by side for a clear comparison. Today, we'll look at 2 key procedures for entering and 3 examples of how to close a position. In our next video, we'll move on to creating actual strategies and backtesting them. Thank you for watching today's video, and I'll see you in the next one.
It's kind of funny that the more we pass time, the more we need to set the rewind.